Happy Friday and happy official start to the summer. This week, I want to talk about 5 slides in 5 minutes, but I also want to take a moment to remember somebody who was very, very critical to financial markets for my entire career for the most part. And this week, we lost a great leader of the Federal Reserve, Alan Greenspan, on Monday of this week. At 100 years of age, which tells us again, longevity planning, more and more important all the time. And it brings me, in remembering Chairman Greenspan, to my thought process on what we're talking about in the markets this week. And in his memory and his honor, I'm going to talk a little bit about irrational exuberance. For those of you that remember, this is the speech that when you look up Alan Greenspan's famous speech, it goes to the Irrational Exuberance speech, December 5th, 1996, as the technology bubble was starting to develop. Markets were overheating a little bit. He came out with his speech around markets potentially being irrationally exuberant, getting a little ahead of ourselves. Now, Chairman Greenspan was definitely right, but he was early. If you remember, if you were invested during those time frames, markets continued to grow significantly for the next 4 years before their ultimate collapse starting in March of 2000 in what we remember today as the tech bubble. So in Chairman Greenspan's honor, I want to talk about irrational exuberance in today's market. Do we see it, and where do we see that if we're looking for it in today's market? So to answer that question, yes, we do see today irrational exuberance exhibiting itself in a variety of pockets in the market. And let me talk to you a little bit why. I'm going to share 5 charts with you really quickly. They're all available. If you have the desire to do a deeper dive, let us know. We'll send them to you. But the first chart talks about price to earnings ratios, which is essentially how much are we paying right now per dollar of earnings in corporate America, and how does that compare to normal historical averages over time? If you look at this chart, I did my best to circle some of our prior peaks, the latest here all the way to the right. We're trading at just over 20 times earnings in the S&P 500. This is down from just over 21 times earnings just a month ago already. And this is a full standard deviation away from your normal average. And honestly, this has only happened really twice before in the last 30 years. Once was that tech bubble of 2000 that Chairman Greenspan's 1996 speech was early to. The other was coming out of COVID right before a pretty nasty 40% correction in the NASDAQ in 2022. So are the markets irrationally exuberant? Maybe. Share prices in certain parts of the company are certainly expensive. And what we're also seeing in my second chart is on concentration. The more concentrated the market gets in a short number of large companies, typically not the greatest forward-looking indicator. We are right now at about 38% of the entire S&P 500 in just the 10 largest names. This is down from 42% just a month ago, but by historical measure, it's still very, very high. My third chart on what do these price to earnings ratios mean when we look ahead 5 years. On the right-hand side, this is a busy dot chart. However, if you can follow my arrow and my little highlight on the left-hand side, at 20 times earnings, historically, the average return over the next 5 years in the S&P 500 has only been about 5%, maybe even only 4%. That's just because stocks are very, very rich and they need to allow earnings to essentially grow into those high share prices. So we've got a few things that we're looking at right now that suggest a little bit of irrational exuberance. My fourth chart is from Goldman Sachs, and it talks about, hey, when valuations, price to earnings ratios are this high, what are the odds of a pullback in the next year? The odds of at least a 5% pullback, which we've almost just about got, it's almost 100%. A 10% pullback, 83%, and you can see the rest. But to suggest that in the next 6 to 12 months, we don't have some sort of a healthy pullback, probably led really by some of the tech stocks that have driven the market higher, fully expected it. For long-term investors, we just get through it. For those that are a little bit more less risk tolerant, that want to be a little bit more conservative, we own other areas of the market, right? I always talk about dividend paying stocks. We talk about the last month, price to earnings ratios and concentration already starting to come down. And as of today, through the month of June, the S&P 500 is down about 2.5%. However, the Dividend Aristocrats Index is actually up 3.1, about a 5.5% dispersion in performance. So we're seeing that rotation start in markets out of those names that have concentrated the market and led us over the last couple of years, and into a broadening of other names across the market, as we've discussed a lot over the last year or so. So my final chart that I will share, which is my fun one on IPOs. We've had a lot of fun conversations around SpaceX and everything that's happened in the last couple of weeks. Potentially some other really big IPOs later this year with Anthropic and OpenAI. This is a fun one just to kind of digest for those of you that are potentially excited about IPO markets and what to expect 3 months, 6 months, or a year after one of these big tech companies does IPO. So outside of SpaceX, this chart shows the 10 largest tech IPOs, over the last decade. And I think what's surprising is just how did those IPOs do 6 and 12 months later, and what was their biggest pullback a year within that first year. So your average return 12 months after IPO is actually negative for these big tech IPOs. On average, a 53% drawdown from its high to its low. So yet again, just another indicator of a lot of companies coming to market for IPOs. That happens when things are going well, times are good, valuations are high. So are we in an irrationally exuberant market? I don't know, but there's a lot of signs out there that say, look, have caution, be defensive, know what you own, don't get concentrated in the market, and be careful and have a long-term perspective, which is why we're here. We're going to be actively rebalancing portfolios over the coming weeks for the middle of the year. This is going to have the very intentional effect of reducing a lot of those companies that have had big run-ups, sell high, buy low, and add more to companies that haven't had as great of a last 6 months. This really does materially reduce risks and help bottom line rates of return with the portfolio. So again, not anticipating doom and gloom, but there's some flags out there that stand up to us just to say, hey, are we irrationally exuberant quite yet? I don't know. Are we as early as Chairman Greenspan was in 1996? I don't know, but important to be cautious, know what you own, and stay patient here through the next 6 to 12 months across the financial markets. With that, have a fantastic start to the summer. Thank you for the opportunity to come to work every day and make a difference in your life and the lives for your families across the board. It means a lot to us. We appreciate it. Soak up the sun. Have a great summer. We look forward to talking soon.